All right, welcome back. Let's do a market update. There's a lot happened in the last 12 hours. We had the FOMC meeting. The rate decision was to leave it as it is, which isn't really all that surprising, but I wasn't worried about it, even if they didn't. I knew they weren't going to raise rates, that's for sure. But they left them unchanged. A lot happened right after. What was important was Powell's conference, right? When they asked questions, and we'll talk about that. What I thought was actually even more interesting was Jeff Gundlach right prior to the FOMC conference. The markets reacted in a big way. The dollar sold off. Gold and silver rallied really hard. Overnight, gold rallied all the way up to 1483, which is a huge move. We'll talk about, we'll look at the chart a little bit. But first of all, not financial advice. Consult your licensed financial advisor. This is more of an educational channel. And listening to me rant and give you guys my own opinions. I could be wrong about the economy, the stock market, and also this is about learning how to trade and giving you guys some tutorials or information, right? There's an update on the repo market already, and it's only been, what, like a few hours? 12 hours since the first article came out from Zoltan, right? That was published on Zero Hedge by Tyler Durden. There's a bunch of more news that came out. What should I cover first? You know what? Let's talk about gundlach. All right. So CNBC Interview, and I posted, because I was watching this live. I was recording it on my phone. In the newsroom, I posted it as it happened. Obviously, if you're in the newsroom, links in the description, you're gonna get updates from me like as I find out myself. So you'll find out things sooner before I make a video, usually a day or two ahead of time. But this interview was pretty awesome, and this aired right before uh, the conference with Powell, which is hilarious. Now Gundlach, he manages a pretty big hedge fund. He's well known, and he's pretty much the only, I would say, true bear that MSM will air. Peter Schiff used to be on, and a bunch of other people, but they don't even bring him on anymore because, they don't want their narrative getting out there. But Gundlach, if you listen to this, it's pretty epic. He pretty much says everything that I've been saying, and a few other people, right, on YouTube. And I mean, he laid it out. He really laid it out. Let's listen to a little bit of it.
That corroborates my viewpoint, which I think is a minority opinion, that in the next recession, if the Fed doesn't do quantitative easing, and Jay Powell has said he will, if we can believe him, and doesn't have a good track record on believability, but in the next recession, the amount of bonds that would be issued at the long end would be so horrifically high that I think interest rates in a normal free market clearing mechanism would rise, and rise fairly significantly. And that's what the repo market is kind of telling us. On September 17th, overnight money was over 2%, and the 10-year Treasury was below 2%. It's really telling that you can't find buyers for overnight money in excess of a 2% interest rate, and yet the 10-year Treasury is below 2%, with inflation at 2% and higher. It tells you that the interest rate levels that are being maintained by the Fed really are not market levels, they're manipulated levels. In the next recession, right now, the national debt is growing at over 6% of the economy. So $1.27 trillion was the growth in nominal dollars of the national debt in fiscal 2019 that just ended. That's more than the growth of nominal GDP in dollars. In other words, all of the growth of the economy in nominal dollars has been the growth in the national debt. We're at 6% national debt growth is consistent with...
So what he's saying is the debt is outstripping actual economic growth, right? Which is huge. I mean,
with the depths of recession with Keynesian stimulus. when the next recession comes, it is likely that the national debt will go up to double digits growth, which would mean bonds being issued in the many trillions of dollars. And I don't think the interest rates would clear at that level without the Fed getting involved with quantitative easing. So the Fed is kind of on the case here. They understand what the problem is. They understand that we have a debt compounding problem and that interest rates would get completely out of control and lead to a mega recession. So imagine if in a recession mortgage rates went up, what that would do to the economy. But the Fed, I believe, will counter that. And what they're doing with the repo facility being increased is kind of proof positive that they are manipulating interest rates and intend to do so in the next recession.
Credit Suisse makes what some have termed a stunning call yesterday, calling for QE4 by the end of the year to deal with stresses in the repo market.
Are they doing?
All right, so they're talking about the Credit Suisse, which is well, those are the Credit Suisse article. I didn't really cover that in my last repo video, but pretty much right after that was Zoltan's article, which some of these anchors actually talked about, like mentioned. So what did I tell you guys? They read the same stuff as I do. They just whoever runs them, right, they all have invested interest. I'm not saying exactly the anchors. All these guys own gold. All of them. They just don't talk about it. But and they hint towards the truth all the time, even all the anchors. It's just that they don't want to cause a panic. That's what it's really about. So gundlach, I mean, he talked about the CLOs, all the corporate debt. In my last video, talked about that as well. He talked about the currency markets. He talked about the repo market, as we just listened to. He talked about the fact that the Fed, I mean, he hinted towards it, that the Fed is going to run out of bullets and the national debt's going to rise so much that they're going to have to do so much QE that we're going to get massive inflation. I mean, he basically says everything that I've been saying for like years now, but I mean, it's pretty amazing. I mean, he even mentioned the articles that I read in my last video, and yeah, I mean, he literally let the cat out of the bag about the corporate bonds, how they're going to get all downgraded, and everyone's crowded into these highly leveraged trades and investments. Mainly because of everyone's just chasing yield because they can't find any because of essentially interest rates being artificially low, right, from the Fed. Yeah, I mean, there was a lot. I just need to remind myself, what else has he said?
Making these dire predictions about corporate bonds and high yield for years.
Well, it's not true.
And you're saying, well, you'd rather be...
It's just not true that I've been making dire predictions about corporate bonds for years. It's just not true. I mean, I made dire predictions about corporate bonds at times over the past years, but those have been good predictions.
Okay, let's say at times. At times.
Well, look what happened in the fourth quarter of 2018. I mean, corporate bonds were terrible.
But this is taking...
Okay, so when anyone comes out and starts speaking the truth here, they always cut them off and they say, well, you've been wrong at this point and that point. It's just to discredit them or whatever for all the viewers. What else?
And other manipulative types of behavior manipulation taxes. I don't think that's going to work. And also, it's tough when you're already late to the game. So I really give him very little chance.
Even with his $50 billion.
I don't think that's a positive. In the Democratic Party today, where...
All right, so he also said that, he called that Trump was going to win. He was right about that. And, yeah, he's saying that he's going to win. I agree as well because... Actually, I don't want to talk about this because, I'm going to get taken down. But it's just the way that things look, that's probably more likely. I changed my mind. Even with a downturn in the economy. Here's the thing. There's a year, right, until the 2020. And if the markets drop... it's still probably, the average person's not going to feel it all that much. They're going to be worried. But at the end of the day, he is the most likely person that in an average person's mind would believe that could pull us out of it or make it less worse. Because if the economy really falls, I mean, the worst thing to have is a new president, right? So I agree with him on that. All right, so Powell was pretty nervous at times during this conference. There's been a few conferences, last few, he did very well. I'm talking about his stature, his presentation. He seemed very confident the last few. But this one, he seemed nervous at times. They brought up the repo market. They brought up a lot of things. And what I got out of it was Powell's making an argument for we can't get higher inflation, and we're going to try to get higher inflation because the last few years, their target of 2%, which it shouldn't be 2%, their target should be zero inflation, but, but because they haven't hit the nominal 2%, which is the core CPI, for the past few years, that means that they could let it run a little higher than 2% now. So when they say they're going to let it run higher 2%, I mean, that means that we're going to get inflation like in the real world that we experience, probably like 5% year over year, something like that, much higher, right? And the problem is once inflation runs at a higher, like noticeably higher pace, and if a panic sets in, then the bond market tanks, yields are going to spike, which will tank the stock market. And then your average consumer retail person, your normie, the masses, might actually start freaking out at some point. Like, wait, why are prices going up? Should I start buying things now before the prices go up later? So then you start getting the runaway inflation. Now, I'm not saying that's going to happen first. We can still get the depression. And that's because of the milkshake theory. In my next video, I'm going to try to talk about the milkshake theory, and then I'm going to wrap it in, and I'm going to try to look at it from both perspectives. And, you could actually end up having both within a short span of time, which is the next 3 to 5 years. And that is a whole nother video, and it's complicated, so I'm just going to leave it at that. Anyways, this conference, what it did was it sent gold much higher, and it tanked the dollar. The rate decision didn't do anything to the markets. The markets they were fine, right? And they didn't really sell off or nothing. A little bit, they sold off a little bit. The 10-year Treasury yield did sell off, though. But looking at this, at the whole, the VIX spiked a little bit, which is the volatility index. So when the market starts falling, the VIX spikes up. It's a way to short the market without outright shorting it. All right? You're just trading on volatility. So why did that all happen? Because, well, let's listen to a little bit of Powell here.
If you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions, and one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific.
All right, like the articles I read in my last video, they all read them, and yeah, everyone a little bit soiled their pants, which they should. So it's not BS, right? And they're bringing it up. Why are they bringing it up? Probably to put a lid on it so people don't panic because of the articles. And it is a concern, right? So they do have to address it because it's pretty obvious.
Specific questions on the year end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates.
Right. So, in translation, through the repo market, they're still manipulating interest rates lower by providing liquidity to the banks and even to the treasuries, which is the Fed, the federal government. They're funding the banks and liquefying and they're being a market maker for the banks, and also at the same time providing demand for the treasuries, which is funding the federal government. And then at the same time, this keeps interest rates low. Because if no one's buying bonds and treasuries, what happens? Interest rates spike. And what happens if interest rates spike? All the debt comes due, and then the market and everything just goes to, So, SHTF. That's pretty much it. Besides that, I mean, he did a tribute to Paul Volcker. If you guys don't know who Paul Volcker is, the last Fed chairman who in the late 70s and 80s during the Reagan era, inflation started running away. There was lines at the gas stations, this and that, and there was high inflation then, and he raised interest rates like 20%. Right now we can't even raise them to 3%, but he raised them back then to 20%, and it was very, very painful. But the economy handled it, and it gave a boom, and that's why we could live beyond our means today, is because he did the right thing back then. He capped inflation, and he reduced the balance sheet. That's why in the Clinton era and the first Bush era, like the deficits weren't bad. They kept shrinking. It was because of the interest rates. And then Greenspan came in and screwed it all up and started the easing cycle back up. Anyways, Paul Volcker, he passed away yesterday or the day before, and he paid tribute to him. And it's ironic because, he's pretty much doing the opposite of what Volcker did. And, Volcker was great to do that, because no one likes you when you do that, because everyone's going to suffer for the short term, but for the long term, it's good for everyone and the economy, because you're normalizing everything. Today, we're so past gone that we couldn't even do that if we tried, or even, like I said, we can't even get to 3%, not let alone 20%. And back then, the U.S. had a stronger economy, had a manufacturing base, didn't have large deficits, and it was, it could handle it. Today, no way. So that's the problem. That's the big problem. The Fed can't do anything besides print, and that's what it's going to do. And what's going to be the consequences? Massive inflation, which gets rid of the debt, because the debt is worth less if the currency is worth less, because all debt is denominated in dollars, and which is credit, right? All right. So, anyways, I mean, Powell was pretty. At times he seemed nervous, and he definitely is signaling to the market, "Don't worry, we have your back." So the market's like thinking, "Don't fight the Fed." So we're going to keep going higher. The question is the market now going to keep going higher? I don't know. I still think there's going to be a pullback or a correction in the next coming weeks or soon. And when that happens, that's when he's going to come out. He's going to cut more rates, and then eventually something's going to happen with the canary in the coal mine, the repo market. Something's going to happen, okay, in the next 4 to 6 months. There's too many things moving around. Not just that, the global slowdown is still happening. We have Brexit. There's another article. There's a lot coming up, right? The China deal deadline, another one. Something's going to happen, all right? That's going to force them to actually come out and say, we're doing QE. They're probably going to wait for a nice 20% drop, another one or something like that. And I'm thinking, that's what I'm sort of game theorizing, that's what's going to happen in the next few weeks and months. We're going to get a correction, a decent drop, just like last year, or at the end of last year, during Christmas. Remember, the markets dropped 20%. everyone was panicking. Even I was calling this to be it. And I turned out to be wrong. They reinflated it because they started cutting interest rates and it worked. So, well, I knew there was going to be a huge bounce. I was expecting a giant bull trap. Well, all the tweets, all the manipulation, they got it to make new all-time highs. All right. So technically I was wrong about that, but we're slightly above where we were at the last all-time highs of the end of 2018. So if this is all-time high in the next few weeks, then I'm still, I'm not going to say I'm 100% right, but I wasn't wrong for calling that. Either way, I adjusted my I warned everyone there's going to be a huge bull trap or dead cat bounce. You could trade that to the upside and then get out into cash and then wait to see if it does make an all-time high. I guess I should be showing you a chart while I say all. All right, so let me visuals help a lot, right? I feel like a lot of people really appreciate that I do visuals. So this is a daily. Let's go to a weekly. It's easier to see. All right, so this is what I'm talking about. The end of 2018, we had this huge correction, right? So 20% drop. Down here, I said this is a nice place to buy. They're cutting rates. You guys could ride this bull trap up. And by bull trap, I meant I thought it was going to roll over and then continue to crash. But then I changed my mind around this time and I said, let's wait and see because we could have a melt up. Remember, for like 6 months, I'm screaming, we might get a melt up. I don't want to spell all that out. Melt. All right. And then boom, we get a melt up. So now we're making new highs. This is the S&P 500 weekly chart. So we're making new highs, slightly higher than the previous high, right? I mean, a decent amount, but nothing too crazy, right? On the S&P 500, like a 10% or something. All right, let's get the ruler out. It went up. It's at 7.26 around that. It's 7 point. Let's say, 26% higher than the previous high. Okay, so it's not like you missed out on too much. You still would have. I did take this trade to the upside. I got out a little early around 2,800, but that's fine. So what if I missed 5%? Of course, you're leveraged up or you're using an ETF, so it's going to be greater. It doesn't matter, guys, because this entire damn time I was holding gold stocks and silver stocks, and there's like a handful that went up hundreds of percent in my portfolio. And I traded the leverage ETFs, which did really, really well. So it doesn't matter. I went long. I just went long in something else, just not equities. And I outperformed any equities out there. All right. So you guys get an idea of how swing trading and how I performed. All right. So, but look, on the weekly, we're on a 9 count coming up next week. I expect something, all right? So let me do this. All right, so let me get the arrows out. Give me a second. All right. This is a pullback, all right? Nothing too crazy. Nothing to panic about. The Fed's not going to panic, all right? That could last a few months or something, or a few weeks, a month, or something like that. Now, if this turns into like a dead cat bounce, so if it does this, and then we fall back down below 2,800, this is when the Fed's going to start panicking again. And that's when they're going to keep cutting rates to like 0. And then the market will probably react to it by, boom, rebounding some. This could take us all the way into the end of the year of 2020. And this isn't a crash. This is nothing near it. If this is like, how much of a drop would this be? This would be a 70% drop, like not even a 20% drop. Now, let me zoom out. Let me see. Look how high. Let me get the indicator off here. So, that would be nothing in the grand scheme of things if we had another 17-20% drop. If anything, all it does is it scares the Fed and they'll go to QE. Right? Even though they are technically doing QE with the repo operations because the balance sheet is increasing. Now, that article I made yesterday, can that happen? Can that all snowball and all that happen? Yes. But I don't think it's going to cause like a huge crash or anything. It's just going to cause this 17 to 20% correction. So I think if that article's right, and towards the end of this year, Monday the 16th and all that happens, it will spook the market and we'll just get this huge drop. But it's not going to be like a 50% drop and everything and it's the end of the world or anything. Because the Fed's going to step in, they're going to do something and they'll get the market to rebound. They'll put a bottom in. That's what I'm trying to say. All right. So this is what I think the worst case scenario will really be if that article's right. Because they're going to come out and they're just going to, they'll cut straight to zero and then probably do QE, right? And they'll put a stop to it. And then we'll see what happens after that. And this could run all the way into 2020. Meanwhile, this entire time, gold and silver is going to just to the moon. All right? That's what I think will happen. Now, yeah, I mean, that's what I'm theorizing. I'm not saying this is going to happen. I'm just saying it's not going to be that easy. This will probably be a controlled like demolition of the markets, and it's probably going to play out in the next like year to 2 to 3 years, something like that, until we really start seeing the S&P and everything down in like, you know, SHTF. So, because they're not stupid. All right. Let's take a look at the dollar because it's definitely on some major supports here and falling. So this is a weekly chart of the dollar. Next support is around the 96.4 handle, 96.5. Now remember, this is the dollar index. It's weighted against other currencies around the world, not against goods and services. Against goods and services, it's been losing value this entire time. Let's go to a daily chart. This is what's interesting. So it broke my blue equilibrium line and the 200-day moving average. That's pretty bearish. So I'm expecting some more downside, which will be, if we take it back to the 3-day or the weekly chart, I think the dollar for the next few weeks and months, it's going to revisit that 94.6, 95 area, which means weak dollar for the next few months. And that's very positive for metals. And I was, like I said, guys, a few weeks ago, I'm like, let's wait and see what happens with the dollar. Let's wait and see until the next FOMC. And here we go. That was a good plan. Most of the time, if you listen, a successful trader and investor, 90% of the time, they're doing nothing. They're just patient. I mean, they're not doing nothing. They're just observing and doing analysis and paying attention, right? You're plugged into the matrix and you're theorizing and you're using your head. You're waiting for confirmations. And then when you get the highest probability trade, the highest probability opportunity, you jump on it. But most of the time you're patient and you're waiting. I don't do day trading. Like with day trading, the more you do, the more mistakes you'll make. All right. I'm going to make an academy with videos and stuff. It's just I need to finish my research. There's still a bunch of mining stocks I need to look at for the private members. And once I'm done with that, and hopefully I'll be done in the next like month or two, I'm going to start making like a library of videos. I'll put it on the website, and I want it to be well done. I don't want to just jump into something. I want it to, if I'm going to do something, I want to do it right, and I need to get the private members settled. Again, 15% off holiday sale till the end of the year. Take advantage of that, and you don't want to miss out if metals keep going higher. Like I said, I don't know how high it'll go. I don't know if it could break a new high, right? I don't know if gold could get past 1566. I do expect it to get past it, up into the 1700 range. But you never know. If something big does happen and the market sells off 20%, you never know. Gold might just go and make new all-time highs in the next month or two, especially if the dollar starts falling in a big way. And then we get maybe we'll get the big crash, and then the margin calls happen, and then by then who knows how high it'll go, and then it'll pull back. But when it does pull back, will the price still be higher than where it is today at 14? Right now it's at 1480. So let me draw that out. People need to. Okay. Let me take it to a weekly. I don't know how high it's going to go. I'm thinking it's only going to go maybe test my 1670 or something and then pull back. But what if something big happens, like a black swan event or something? Well, let me move this. What if a black swan event happens like that Zoltan article, which I'll get to the update. There's an update on that. What if it does? What if something happens, a black swan, and it just shoots straight up and makes a new all-time high, goes to 2300, and then the markets, everyone gets the margin calls, and everyone sells hits the red button, sells everything, and then equities for metals fall. The physical spot price won't fall, but equities will, just like back in 2008 when that happened, right? And then it just falls, but it only falls to 1660 or something, and then shoots higher, and then gold starts heading towards the moon, right? Starts heading towards 5,000. So I don't know if that's going to happen. I'm just saying that's why I'm long. If this does happen, I don't want to miss that opportunity. All right. Because I know a lot of people are strategizing that. All right. And I still have that 9 sell on the 6 month. And I showed you guys this in my last video. I talked more about it. What else did I want to talk about? Let's take a look at silver. I'm actually really curious where silver is. By the way, for the short term, let's see. I'm still bullish. I'm still long. I've been accumulating for the past few weeks, and it's already very profitable. Especially on the open tomorrow morning. If the price of gold is higher than 1480, it's a sweet trade already. Pretty awesome. Especially on leverage ETFs, which you should not trade unless you have 6 years or something experience. Is this going to delete or what? Come on. Delete. Alright. Alright, let me zoom in and get to the 3-day charts and stuff. Let's take a look at the 3-day on gold here. Okay. I'm getting angry with TradingView. Something changed in the settings. They update stuff and I'm not used to it. And then I'm making videos and I don't want to edit the video. That takes hours, and I'm just going to leave it as it is. All right. I'm still bullish. We got a 1-2. If the 3 candle on the 3-day chart if the price tomorrow can just get above 1486, it's very bullish. And once it gets above 1500, it's going to start running. So the 3-day chart, very bullish. I'm looking at the oscillators. The RSI is just starting to rise. The MACD, all of them. The momentum indicator, or not momentum. Well, yeah, the momentum indicator. The MACD is going to cross to the upside. TM squeeze looks... Everything needs to reset to the upside on the 3-day chart. Every candlestick represents 3 days. So I'm looking for some weeks, a couple weeks at least, of upside here. Let's take it to the daily, see what that looks like. Daily is kind of neutral, just looking at the pattern of these candles. And it really does need to break above this red Ishimoku cloud and some of these moving averages. Like I said, I really want to see the price get above 1500. If it could do that, then it's going to run. Now it's going to test 1500. It's going to struggle, but hopefully by the end of this week, we could at least test 1500, get above it for like an hour or so or something, right? Let's take a look at the oscillators. It might lose momentum though, but hopefully fundamentals in this conference could override that. Also, repo numbers are going to get published. I'll make a video later today, actually tonight, later. Like right now, it's early in the morning, 6 a.m. So later today, like U.S. Eastern Standard Time, so like 12 hours from now, something like that. I'll make another video updating. And I'm going to make a Bitcoin video. People keep asking me. Guys, I'm not like super bearish on Bitcoin for the long term. I'm just for now, for like maybe 6 months to a year or something. Let's take a look at the 6-hour chart. It's neutral. It's bumping up against the 200 period moving average on the 6-hour. Oscillators are a little overextended. So it might not test 1500 this week, hopefully next week. Let's take a look at the 4-hour chart. 4 hours coming up on the 9 sell, so it's probably gonna, on the open, it's gonna drop back down. But just the fact that gold ran to oh man, I mean it ran to 1490 back on December 9th. What? On December 4th. Today's the 12th, right? So overnight it ran to 1483. So it's coming up against resistance. So as long as the price can stay above 1470, I'm not worried. And then it might consolidate for the rest of this week and then maybe move higher. Or maybe it'll just keep moving higher as the market opens based on basically the hearings, right? Or the conference. Either way, for the longer term, let's take it to a weekly. Let's bounce around here. I forgot to take a look at the weekly. On the weekly, it's still very bullish. So look at this RSI, extremely oversold on the weekly for gold. Momentum oversold. All right, guys, so I'm still holding long, no big deal. My trade's positive. Silver. Let's take a look at silver. Okay. Silver. Come on. All right. Let me zoom in here. Silver is at $16.90. Once it gets above $17, it's looking strong. If it could just get above $18, then it's gonna start running higher. Just like gold needs to get above 15. All right. This is the daily chart. Let's take it to a weekly. Yeah, it looks good. My blue candlesticks, that's this indicator is awesome. I don't share it with you guys, but I share it with the private members. It's on a 6 count on the weekly. So maybe some sideways trading. So silver is going to lag gold and probably have a hard time getting above like 1750. But I would say 2 weeks from now, it's going to hit a 9 buy signal on the weekly, and then it's going to start going back up. So it's probably going to lag gold. So you could take advantage of that that ratio, the gold to silver ratio, which is probably, let's take a look. All right, here we go. Let's take a look at the gold silver ratio. Dollars. Yeah, it's still at 87, guys. Its all-time was at 94, which is insane. When this ratio corrects, silver, if you guys haven't watched that Mike Maloney video, $150 silver, no-brainer. Just type that in, Mike Maloney, 150 silver, no-brainer. It really is. I think $100 in the next 2 years is very possible. And if silver does, right, because it's only at, where's silver at? It's like at $15. If it goes to 100, the mining stocks are going to do like, you're going to see 1,000% returns. Stuff like that, all right? I'm not guaranteeing anything. That's what I'm expecting if silver does go to $100. And because it's been manipulated and suppressed for like over a decade, and by the way, JP Morgan, they own the largest physical hoard, probably for a good reason. All right. Let's get to the news and articles. So, Zoltan update. The repo apocalypse. In the aftermath of Zoltan's stunning doomsday report about an upcoming crisis in the repo market, which we discussed extensively yesterday, and which predicted that the Fed may lose control overnight rates, leading to a vicious dislocation in the repos coupled with a paralysis in the FX swap market, the Forex markets, many traders who pretend to understand the implications of what the former Fed strategist said. Are they talking about me? Because I think I'm probably the only trader who talked about, probably. Whatever. This is a Zero Hedge article. Have quietly hunkered down and are looking carefully for signs that Zoltan is correct. A worst case scenario that could then lead to a spike in treasury yields, a forced deleveraging of the hedge funds, and a plunge in equities. In short, a stock market apocalypse. But what are the signs that Zoltan is looking at to determine liquidity crunch is imminent? There are two key leading indicators that serve as advance warning that, okay, I talked about that in my last video. The first thing to watch to determine if the apocalypse 2.0 is about to hit is the repo rate itself. While the overnight general collateral repo rate remains dormant, the same cannot be said about its forward cousin, the term repo rate, which covers the year-end period of December 31st, January 2nd, in which, as we pointed out last night, has jumped to 4.1% as of Tuesday. It jumped to 4.1% as of Tuesday, and which on Wednesday moved wider by another 5 basis points to 4.15%. So that doesn't seem like a large jump, but I think it is for these repos, according to Curvature Securities. Okay, as a reminder, the last turn saw an overnight GC repo soar as high as 6%. So that looks pretty big, that spike on this chart. Doesn't look normal. So it is safe to assume that with about 100 billion less in reserves, the overnight repo may rise as high, if not higher. So 100 billion less in reserves for the banks. The second and perhaps more critical indicator of coming market crisis are Forex swaps. See, the Forex swaps, it's a little hard to understand. When you Forex trade, you leverage like crazy. It's like minimum 100x. And these hedge funds and institutions and banks are doing that because they can't find yield anywhere else. All right, except JP, I guess, on 30-year treasuries. Recall Zoltan warned that as a result of lack of bank reserves spread evenly across the system, the Forex swaps could end up as an orphaned asset class without an obvious backstop, and that may force banks in some parts of the world to edge of the proverbial abyss. As a result, the year-end in the Forex swap market is shaping up to be the worst in recent memory, and markets are not pricing any of this in. So basically, you know what's funny? The dollar did fall right after the conference. So that might be wrecking some big whales in the Forex market right now. Not to mention that there are a few repo market experts as like Zoltan on the nuance of financial plumbing as Zoltan, and may well be right. If he is correct about another even more stunning allegation that at least one large U.S. bank appears to be pricing some of its Forex swaps trades such that it misses those trades, like I said, the dollar falls, maybe they were betting it would rise, a polite way of clamping down market making activities. We translated this as follows: at least one large U.S. bank appears to be actively pushing for a collapse in the Forex swap market, with a very specific intention to force market crash in the coming days, forcing the Fed to launch full-blown QE4, which they are front-running by buying treasuries. Because you could argue that JP Morgan's searching for yield with treasuries, and it's a better trade than holding equities, because equities at all-time high, guys. I mean, it's a big bubble, right? So you would want to take a safer bet, meaning you would want to hold maybe long-term bonds, and you would actually gain, holding bonds is kind of like a growth stock now, instead of holding equities, which are like trading like bonds. Because like I said, guys, for the stock market to keep going higher, the market cap has to exponentially grow, and that means that the Fed's balance sheet would have to explode, and they don't want to do that right away. They're only going to do that when there's a crisis, because the Fed's not going to shoot every single one of its bullets before a crisis. That's why it's kind of stupid to expect that these markets are going to keep going higher and higher. Expecting Dow 50,000 and the S&P 5,000 is a bit naive. That means you think this time's different, and the Fed's going to push the markets that high. The melt-up phase might kind of be over now. This was the melt-up. Why? Because do you know how much credit expansion and how much the balance sheet of the Fed would have to explode to be able to do that? Because the market cap of the entire indices would have to explode. And where is all that going to come from? Well, the one argument is, well, it could come from emerging markets, Europe and Asia. True, and they're the reason why we've been getting this melt-up, besides the repo and the balance sheet expansion as of late. But remember, the balance sheet has fallen a little bit in 2018 because it started raising rates. It hasn't really exploded up for the Fed. I hope that made sense. If it didn't, rewind this and listen to it again. All right. And as the chart below shows, both Euro and Japanese 3-month swaps. You guys remember the carry trade with Japanese yuan and metals and the interest rates? I don't want to get into it. Anyways, swaps have started. It used to be a good way to trade metals. I don't look at it anymore, though. I think it's decoupled ever since we gone into the beginning phases of this bull market in metals. Okay, so let me read this again. And as the chart below shows, both Euro and Japanese yuan 3-month swaps have started to push, not yuan, yen, to push sharply wider in recent weeks. As Bloomberg points out, the premium to swap Japanese yen into US dollars for 3 months, a bet on rising dollar scarcity, widened more than 4 basis points to the highest level in 7 weeks, while the spread to convert euros into dollars expanded by as much as 6 basis points. All right, what the hell does all that mean? I mean, the trade, if you were bullish in dollars, is not working out. All right, so as a reminder, as we have pointed out since 2015, a widening in such basis swaps confirms that a dollar funding squeeze is building. And while these were relatively normal when the Fed was engaging in QT, quantitative tightening, a shrinking in its balance sheet, a repeat when the Fed is once again aggressively expanding its balance sheet, is a problem to say the least. Looking at the charts above, there is good news in that none of the current reads are remotely as apocalyptic as Zoltan is making them. However, there are 3 critical dates in the coming week that could result in violent move wider in both swaps and repo rates, which would then instantly cascade to the rest of the market. They are the following. If the Fed announces operations of $25 billion or less on those days, then turn rates will immediately spike. So if they do less than $25 billion in like December 30th, like the next week, in the repo market, like, putting more than 25 billion in, that could cause spikes in yields. Although Powell just said that's what they're doing. They don't want the yields to spike, so they're providing liquidity for the repo market. All right, China tariff decision. While not directly linked to the repo market, an adverse outcome here would result in a sharp drop in the risk assets, tightening in financial conditions, and a spike in the dollar, which would have an indirectly adverse impact on bank liquidity, potentially exacerbating an underlying funding shortage. My other phone usually doesn't keep beeping like this. I'm sorry about that, guys. It's just really weird that it's doing that nonstop. All right, Treasury tax remittances. This is the third thing on December 15th. So the last thing, China tariff decision. If that goes bad, December 15th could cause the repo market to get a little, wonky. And the reserves for the banks are going to fall. December 16th, Treasury tax remittance, a major liquidity drain. If the level of reserves is indeed catastrophically low, this event could trigger a blowout in repo rates as banks transfer reserves to the Treasury. As a reminder, many attributed to the first repocalypse to a tax payment made on September 16th. Here's the thing. The Fed knows about that. I think I'm going to take a look at they're going to be injecting a lot of billions in the next few weeks. I guarantee it. Just to keep all this from, getting out of hand. All right. So I don't think this Zoltan prediction is going to happen in the next coming weeks or anything. Although everything he says is a problem, ongoing issue, and it's going to be ongoing for the rest of this, as we move forward. I don't think it's going to go away. Deutsche Bank breaks down how tomorrow's election will impact UK markets. Listen, guys, I don't like talking about Brexit because I don't know what's going on. It's so, it's been going on for years. Obviously, it's like, if they can't get away now, will they ever? I don't know. I don't even want to talk about it. Until something happens, until there's a final decision, I feel like it's so annoying. The market, it doesn't really affect the market all that much, but if there's a final decision, it might. Visualizing the dramatic rise and fall of cannabis company stocks. Yeah, guys, the cannabis bubble, that thing burst. And I warned about that. A lot of people kept asking in 2017 and 18 about that, and I kept telling them, listen, that thing's a bubble. It looks great. I mean, if you were early and you made money, good. Take some profits off the table. At least get your money back that you invested, right? Because that thing's going to pop. And it did. As soon as we had a 20% correction in the S&P and the rest of the markets at the end of 2018, going into the beginning of 2019, that was the time for you to get out. And I believe I warned you guys. I said, cannabis is going to fall big and it might not recover. All right, the global auto market collapse in 4 charts. I'll post this in the newsroom because I've talked about this plenty of times. And this is global. It's not just the U.S. What the hell? Anyways, listen, I'm waiting. I have an old car now, and I want to buy a truck, and I really want to do it before winter, but I'll survive. My car's works just fine, and I think I'm going to wait because I've been waiting for many years now. So now I'm just going to keep waiting till the best opportunity comes. I'm talking 30% off, like 40% off. current prices. I wouldn't be, in the coming couple years, 3 years, something like that. So I want to wait at least till the car bubble really starts falling, and you get a solid 20% off, 25%, because the prices are still technically pretty high. They're overpriced. And those websites you use to find like used cars, I've never bought a new car. That's stupid. But a lightly used car, like a car with 10,000 miles or something like that, or 15 or 20, that's fine, guys. I mean, you're saving right off the bat. When they roll off that lot, you lose like $6,000 or something. So, buying a very lightly used car, you take another 15-20% off, maybe by next summer, or definitely going into 2021. You should be able to get a huge discount price to today's prices. You just have to wait it out, Although if you go on like Craigslist, like real markets, not like the websites for like auto. I don't want to name the websites, but you know what I'm talking about. They're all rigged, guys. Just go on to those other markets where private sellers are selling. Of course, you need saved money to do that, and it's hard to get loans. I get it, but it's one of the things when I profit off these mining stocks, I'm gonna just take a little bit off the table, go buy a nice truck. I'm also waiting for that too, for my portfolio just to appreciate massively, because I'm waiting out on a lot of things. I want to go buy some more gym equipment and stuff, and it's like every $1,000 could easily be much more in the next couple of years. So it's delayed gratification. That's why most people aren't rich or don't, have big. Most people cannot fathom delayed gratification. For years, you have to be disciplined and build up savings. That's why savings builds, is good for the economy, and that's why Keynesian economics and all this Fed stuff is bad. It goes directly against savings. When people save, what can they do? They could build businesses with it. They could allocate their capital and buy stocks and stuff, which helps corporations and other businesses grow, which creates more jobs. Get it? That's how Austrian economics looks at the economy, not the other way around. All right. Sin. So you guys can read this article. Basically, I mean, all the night, like in New York, they put more taxes on pop and sugary drinks. Well, you're going to see more of that, like, alcohol, stuff like that. That's why the prices are just going to go up because of that. So I just want to, talk about that for a second. So that's it for now. Smash some likes. Leave anything in the comments section. Please share my videos. It's the only way my channel will grow, and I will continue to do this. Join all the free chat groups. If you're interested in the private group, go to my website, 15% off, and I don't know, look at all the links in my description. I add stuff like all the time, and I take away stuff all the time. So if you see an opportunity, there's links for discounts and stuff. All right, guys, until next time.